Hello investors and traders, today I will speak about 3 high-yielding dividend stocks that boosted their payout by over 25% within the past year. One of these stocks have even doubled its dividend. High-yielding dividend stocks are great for long-term investors. What is even better are stocks with high payouts that also increase their dividend payments. These stocks pay more than the S&P 500 and have recently increased their dividend payment by 25% or more. They offer the best of both worlds, high yield and high dividend growth rate. And let's start for the first stock. It's National Research Corporation, NRC. It is a healthcare company focused on analysis and generating insight that company can use to improve experience for both their patients and employees. It offers human understanding, enabling businesses to become familiar with those whom they serve, including their preferences, needs, and wants. The company's solutions are on the subscription basis, so they offer a fair bit of stability. As a result, NRC financial have been growth steady over the years. The company suspended its dividend payment during the early stage of the pandemic and then reinstated them initially at a lower level. Let's check out the chart of this company. We can see that now we are trading in the decreasing channel since the pandemic lows, and now actually we are here we have a very major support level. It is about $40. Actually we are trading at the levels of 2017, so very interesting to watch this stock. Let's check out the fundamental parameters of the stock. We can see the total score is very high, about 29%. We can see the financial stability is very high mark. The debt to EBITDA ratio less than 1, interest coverage is very impressive, 34. So any problems with that at this company? Also Altman, the score is about 10, so the probability of default in the futures year is actually about 0. It's a very high marginality company. We can see gross margin is 62, net is about 23, and the growth rate for the last years of the EBITDA revenue is more than 10%, and free cash flow and the other parameters also show the very nice growth. But now the current P ratio is 28. It's not cheap, of course, but we can see that the PS ratio is 6. For such marginality, it's okay, it's fine. Also, let's check the dividend. Forward dividend yield is more than 2%, and the payout is less than 1, so half of its net income company pays as a dividend to its shareholders. The company suspended its dividend payment during the early stages of the pandemic and then reinstated them initially at a lower level. So this dividend yield, its yield is still better than the S&P 500, which has average of 1.50, and it could make for a good income stock to hang on to now that the healthcare industry looks to be returning to normal. And let's move to the second stock. It's UPS, United Parcel Service. It's a top logistic company that has a crucial role in e-commerce, shipping products all over the globe. In February, it announced an impressive 49 increase to its dividend as it benefited from strong demand during the pandemic. But unlike NRC, the logistic company didn't cut or suspended payout in recent years. UPS has been increasing its dividend payment consistently since 2010. Its yield is over 3%, is higher than NRC, and with the payout ratio of around 40, there is still plenty of room for the company to make more rate hikes in the future. Even when the company heading for a possible recession, UPS business remaining strong. And another sign that the business is doing well, UPS is planning to buy back its up to 3 billion shares this year. And let's check the chart of UPS in my mind using the Elliott waves. It is a monthly chart. We had the first wave, the second, the third, usually the most longest wave in the impulse, then a correction, the fourth, most probably it was actually triangle. Here we can see A, B, C, D, and E, a triangle, and then the fifth finish. So now we have a correction, but yeah, it's correction. Maybe here it's some kind of range. Yeah, most probably this is a range. But it's nice, it's still nice, it's have a dividend more than 3%, so why not to buy the stock now. Also, I can see here the P ratio is 14, is less than NRC. 14 EPS, in my mind it's very cheap. It's actually in the middle, and it's the middle P ratio for the last years, and also very cheap PS. Price per share, please have a look that it's only 1.5, so but actually in the history it was all the time so cheap. Even sometimes it was 1 PS price per share, but from this point it's not expensive at all. And the marginality now it's 11, so I think this 11 for a logistic company net margin is fine. So this is a safe stock to own, and while I wouldn't expect to see a 40 rate hikes on a consistent basis just due to sheer size, the company could make large increases to a dividend in the future, especially once economic conditions improve. Let's check the last stock for today. It's HP. HP is known for its computer products, including its popular printers, laptops, and accessories. The business is a good position to benefit from more people working remotely and business updating their IT infrastructure in order to do more of their operations in the cloud. HP has a nice dividend yield, more than 3%, and the company raised its quarterly dividend payment by 29% last quarter. So let's check the chart of HP. We can see that in my mind since 2011 was the first way, the second, third, the fourth. Of course it's not ideal, but there is a probability that it was the case. And the fifth. Here it's not clear that fifth wave finished here, or we can see another move up, something like that, and then of course the impulse won't be finished. So from here before until we won't break out this rising channel, we can say that this wave is finished. So also please have a look that in the RSI, the momentum indicator, the weekly chart, we are already oversold. So from this point I think that there is a nice probability to see bounce. Also its current yield is dividend yield is 367. It's quite impressive. And let's see the P ratio. And the P ratio of this stock, we can see that only 4 is much better than 12, much better than 14. So P ratio is very cheap. The PES ratio even cheaper, we can see less than 1. So yeah, now it's very cheap stock, HP. And now also please have a look that it's a profitable company. Of course the company has profits, so it can pay dividend to its shareholders. So its net margin is more than 7%. For me it's okay. So today we analyzed 3 dividend stocks. Their dividend stock is now more than 2%. They increasing it dividend. Also the payout is very nice. There is room for increasing. So if you like this video, don't forget to subscribe, and see you on the next time. Bye.